It's not about how much you earn, it's about how you manage what you earn. Whether you earn 50k or 500k, the strategies used by the top 1% to manage their finances can be used by anyone. In this video, we'll explore the 65-15-20 rule, which will help you manage your finances like an expert. Now, there's a few different splits out there, and advice has changed over the years, but the most important thing is to have that target and stick to it, so you don't keep moving the goalposts. So we'll start with the biggest one, and that's allocating around 65% of your take-home pay to your fixed costs and your fundamental expenses. So that's things like your rent and mortgage, utilities, groceries, transportation. By maintaining this cap, it ensures you live within your means and prevents lifestyle inflation. It also encourages you to focus on value. Just because you can afford something doesn't necessarily mean it's a sensible purchase. We should always be looking to get value on our money. And by knowing where our biggest expenses come from, we can then look to see how we can optimize them. So for example, can we negotiate a slightly different rent? Can we make sure we're on the best mortgage for our house? Can we look at some slightly different alternatives in terms of transportation? Make sure we're on the best utility plans. A big one for me is actually seeing how much you're spending on groceries, and whether you do a weekly shop or whether it's just sporadic and you're going into the shops potentially every day. Having a bit more of a structured plan around your food shopping can make a massive difference to these fundamental expenses. Even though it's a percentage, once you have this cap and you get used to that level of fixed costs and fundamental expenses, when your earnings then go up, what's really then good to see is by keeping this cap the same. So when your earnings are going up, your expenses are not just going up in line with it. When your earnings go up, you can then put it into one of the other two areas, which we're going to move on to now. So next up is 15% allocated towards your savings and investments. This is reserved for you. The first thing we need to make sure we've got set up is an emergency fund. Now, just 1 month to start with. This is all about peace of mind, whether it's an unexpected job loss, medical expenses, or the car breaks down. By having that money being able to cover these expenses ensures you don't have to go into debt in order to cover them. You want to have this parked away in an easy access, very liquid account that's still getting a good interest rate, but you're not going to touch it and use it for other expenses. In terms of how much an emergency fund should be, remember this is not covering everything that you spend. This is just covering our core expenses. So what's the absolute essential minimum that you can survive on? Essentially the 65 that we've just talked about, those fixed costs and the fundamental expenses. So it's not always as big as it first seems. Once you've got that month, the next step is then to try and build it up into 3 to 6 months. Once you've built it up to that size, it's the ultimate peace of mind. You know you can cover whatever comes up in the future, and it allows you to focus your efforts more on long-term investing, which we're going to move on to now. This is all about making your money work for you. So making sure you're getting the best return for your money, having that long-term approach. So we've covered the short-term expenses now. So now we're thinking about saving for the future, allowing our money to compound and work in the stock market over time. The key here is to start as soon as possible. Timing the market is so much more important than timing the market. Let me show you an example. If you start investing at the age of 30 and you're able to put away 250 every month, using a rate of 7% per year, which is what the stock market generally gets on average when we take into account inflation, then over a 20-year period, at the end of that, your investment would be around 130,000. Now, if we compare that to starting 10 years later, we're going to double the amount that we can invest per month to 500, but we're only going to be invested for 10 years. At the end of that 10-year period, you would have about 86,000. That's around a 44,000 difference. Even though we're investing double the amount of money, because we're starting that much later, we've got less time in the market, so less time for that money to compound. Keep it really simple with your investing, so you'll have the majority of your money in index funds, whether that's be a global fund or whether you want to be more specific, like the S&P 500 covering the American market. That's up to you, but keep it really simple. They're very low cost and easy to manage. You don't really need to do much for them. You can just invest on a monthly basis. You can use Trading 212 or Invest Engine. I've got 2 links in the description below. If you use either of those links, you will get some sign-up bonuses as well. So take a look and get started as soon as you can. The third part is allocating 20% of your take-home pay to guilt-free spending and enjoyment. It's not all about saving and cutting back and investing for the future. An element of this has to be living for today. And by allocating a specific amount to those fun activities, it actually will encourage you to stick to the other parts as well. If we try and cut back too much and be too strict, we know that actually we're going to end up burning out. So by having that balanced approach, it actually promotes long-term adherence to the plan. You also enjoy the activity more as well. When you go out and spend something that you probably shouldn't spend, whether it's going out for dinner, whether it's going away, whether it's buying a present, when you know that you shouldn't really be buying it, but you get a bit carried away and you just get a bit excited, you lose some of the actual dopamine and the actual enjoyment that you get from purchasing it in the first place. Whether you've already allocated a specific amount where it doesn't really matter what you spend it on because you've already allocated that money, and that's guilt-free. It doesn't really matter, but as long as you've got a rough guideline about how much you should actually be spending. That's my top tips for managing your money like the 1%. Thanks for watching, guys. If you enjoyed it, I really appreciate dropping it a like, subscribe if you're new, and I'll catch you in the next one.